They knew this was coming. I'm your host, Steve Van Metre, and thanks for joining me today. And we just got some data from the government that shows the U.S. consumers' outlook on the economy is in terrible shape as the data series has crashed the most on record. In our lead story, we also have evidence that we've been talking about that the government knew this was coming when the BLS cooked the books on the last payroll report. We now see it in the data, and this is going to have serious knock-on effects for monetary policy that's coming next month. Plus, the Biden administration, they too are now backpedaling on some data, on some planned releases that they knew were coming. And again, this has major implications for the U.S. consumer and the economy. Let's take a look at all of that, but let's head over to Bloomberg, where we pick up our lead story with the headline, U.S. inflation stays elevated, adding pressure for more Fed rate hikes. And that's really the key here. You start to look at this inflation data and Fed rate hikes. It's all that matters. We're hearing the Fed say, look, as long as inflation's running above our 2% target, we want to tighten. But as we go through this, keep in mind, what did we hear from Powell recently at the last press conference? And then at the economic forum that we covered that he spoke at in New York, is that his tone had softened. He's still hawkish, but that hawkishness sounds almost a little dovish. Maybe there's some reasons why. The overall consumer price index climbed 0.5% in January, the most in 3 months, and bolstered by energy and shelter costs. We're going to get into why that happened. According to data today from the Bureau of Labor Statistics, the measure was up, we should say 6.4%, but it actually slowed to 6.4% from a year earlier. And we know that this has everything to do with the changes the Bureau of Labor Statistics made to the data. They knew this was going to happen. This should not be a surprise to anyone, but the key part is that year-over-year rate of change is slowing down. It's actually closer to the 6.3% range, but nevertheless, they've rounded it to 6.4. The question now is, are we going to see a big deceleration in consumer prices in the months to come? The answer remains yes. Here we look at this chart with one we look at frequently on the show, consumer price index in blue against U.S. regular, all formations, gas price in red. And what we can note here, what's happening? Why is the CPI not decelerating rapidly down? Well, you can look here and see how gas prices stayed elevated. And we know the CPI lags in the energy sector. So there is some point in the months to come, we're likely to see the year-over-year rate of change in the CPI drop substantially. And we've seen the periods like this before, where gas prices remained high, they started to come down, and the CPI, you can see hidden behind there in the blue line, took a while before it started to follow suit and come down. So we know this is going to happen. Excluding food and energy, the so-called core CPI advanced 0.4% last month. No surprise, it was up due to all of these changes that BLS made, and was up 5.6% from a year earlier, or again, we'll say slowed to 5.6% from a year earlier. Economists see the gauge as a better indicator of underlying inflation than the headline measure, and sure enough, it is, and we can see just because it smooths out all of the volatile food and energy, and we can tell that shown in red, the core CPI, it too is headed lower, but now it looks more like that top that we saw in gasoline prices, even though you might say, well, wait a minute, it doesn't include food or energy, right? But you think about everything else in the CPI, how does it get from place to place? It gets there through energy. So gasoline, while it's not part of the core CPI, it does feed into all of the production costs, transportation costs, and all the things that go into consumer prices. It's there for sure. Both annual measures came in higher than expected, not a surprise because of the recent change that BLS made, and showed a much slower deceleration in recent months. The figure remains far higher than the Fed's 2% target, which is based on a separate department index. And here we can see what the knock-on effect is. Now we have the next FOMC meeting coming in late March, the 21st to 22nd. So what does that mean is we have one more CPI print. Is it likely to come down? Yes, it is. Is it likely to magically get down to 2%? Not even close. That would be a statistical anomaly at this point. But what have we noted, at least what did JP Morgan say, that there's some point where we start to see the CPI index due to its reweighting and re-seasonal adjustment and all all the changes they made start to tilt the other way. Now, maybe we'll see that by March. I don't know. But if we don't, it still leaves the Fed in play for another 0.25% hike. But as we know, Powell didn't seem too confident. So we'll see if there's some other data that suggests that maybe the Fed will pause. The figures, when paired with January's blowout jobs report and signs of enduring consumer resilience, underscore the durability of the economy and price pressures despite aggressive Fed policy. The data supports officials' recent assertions they need to hike rates further and keep them elevated for some time and possibly to a higher peak level than previously expected. So here's my question to you do you believe that what we're seeing, as this article says, that signs of enduring consumer resilience, is that what you believe is driving consumer prices to stay elevated at this level? Or do you believe it has something to do with all the seasonal changes and reweightings that the BLS made? Well, I'm going to give you some evidence. It's actually the latter here in a little bit. The details report showed shelter was by far the largest contributor to the monthly advance, accounting for almost half of the rise. Used car prices, a key driver of disinflation in recent months, fell for the 7th straight month. Energy prices rose for the first time in 3 months. But get this, shelter costs, which are the biggest services component and make up about a third of the overall CPI index, rose 0.7% last month. Owner's equivalent rent and rent of primary residence increased by the same amount, while hotel stays also climbed. But here's what you don't know, or what they're not telling you, is that owner's equivalent rent is a completely made up number. The Bureau of Labor Statistics admits they have absolutely no way to calculate what it should be, so they make it up. And that's why it shows up as a lag in the report. And at some point that's going to shift. But that's not the biggest issue here in the reweighting of what just happened. Let's continue on. Because the way the housing metrics are calculated, there's a significant lag between real-time price changes and the government statistics, again, because they're literally making it up. The January report incorporated new weights for the consumer basket to try to more accurately capture America's spending habits. The shelter component, get this, are now a larger share of the overall index, while used cars make up a smaller portion. So now you have it. They knew this was coming. They knew this was going to happen. The BLS changed the report to give it higher weighting to a data series they literally make up. And then they took one they have actual data on, which is used car prices, and they reduced its allocation. So at some point, what we're going to see is there's this lagging effect of rents that comes into the report that's going to shift. It's going to push this thing to the downside, but it's not here yet. May not be in March. We'll soon see. But one of the questions people keep asking me is, why do the markets keep staying up? Well, you got it because the computer models are not selling here. Now, if you want to know when you should be backing off your long positions, you need to sign up for CTA Timer Pro. There's still a $10 off coupon. You can see small caps are starting to back off a little bit. They tend to lead the larger ones. You want to know what happened in the bond market? Well, the report was telling you every day how the machines look at it. Again, there's a $10 off coupon in the description. There's only a few of those left before it's gone, and then it's at $30. Those that are on it for 20 are telling me this is the best report they've seen, and you'll want it. So jump on it. 30-day free trial. But now let's look at how bad the consumer is, because again, the government knew this, because I'm going to show you government data. So you see what they did. They changed the CPI report to make it so the index went higher. This is going to push the Fed perhaps to another hike. But the question then becomes, where's the consumer at? Well, let's take a look. New York Fed survey finds household income expectations plunge the most on record as inflation sees extending its drift lower. Look at this, this is from Zero Hedge. They go on to say, after increasing each month since September of last year, the median expected growth in household income dropped by 1.3% to 3.3% annualized, the largest, get this, 1 month drop in nearly the 10-year history of the series. Now, why is this important? Why do we think about, household income? These are expectations, because people that are working have a fairly good idea if they're going to be getting a raise or not. So they are actually reasonably good at judging this, and it's considered a leading indicator. So here you see the largest drop in the recorded history of this data series, that incomes are coming down, the rate of growth is slowing. At the same time, the CPI index is reweighted to show that it's not moving down as fast as we needed to, so the Fed can continue to hike. And how does this tend to show in consumer spending? Well, you've got it. It's coming down. Adding to the gloomy household finance picture, along with a drop in household income, we saw continued declines in the median household spending growth expectations, which decreased to 5.7% in January from 5.9% in December. This is the third consecutive decline in the series, which should be of no shock to anybody, because when wages do not keep up with inflation, what do people have to do? Spend less. And when people spend less, the economy slows down. You start to see layoffs, a la the tech sector, which we've been seeing, and then that eventually translates into retail sales growth slowing, which we should see later this week, which then again turns into lower inflation. But now let's take a look at what the White House is up to, because they're starting to backpedal. But maybe I want to get your opinion on this and see if you think they're going to go through with their claims that they're going to pull this back, or are they going to let it go through? U.S. to sell 26 million more barrels from the strategic oil reserve in something the government knew was coming. I want you to understand this. This is the theme of today's show. The congressionally mandated sale will amount to 26 million barrels of crude. The sale is in accordance with a budget mandate. Get this, they've known about this for this is how long? In 2015 for the current fiscal year. The Energy Department has sought to stop some of the sales required by the legislation so it can refill the emergency reserve, which currently has about 371 million barrels remaining. After the latest release, the reserve will dip to about 345 million. So I want you to think about this. When the Biden administration started releasing crude oil to bring inflation down, guess what they knew was on the calendar for this month? It has been around since this 2015 legislation. They knew what this was coming. Now the question is, with CPI still running at the current rate, with the wage growth predicted to continue to slow, what do you think they're going to do? Is this a bunch of rhetoric? Are they just going to say, hey, we're probably going to do this, but then turn out they're not? Or are they actually going to put a stop to this? I'll let you be the judge, because now we're seeing some inflation that may show up in a different place that we've never seen before, but I'm going to give you the reason why I think it's not going to happen. There's a new inflation warning for consumers coming from the supply chain. In 2022, we saw rates levels for international air and ocean and domestic trucking fall back down to earth. But inflationary pressures remain where demand outpaces supply in 2023, including the space we never have had to worry about, warehousing through most of the United States, domestic parcel, and labor. One reason for the imbalance between warehouse supply and demand is the lack of new facilities coming into the market, or how about we rephrase this to a lack of consumer demand? Because if there was consumer demand here, we wouldn't need more warehouse space. So now again, the article is saying, hey, we don't have enough warehouse space because we haven't needed it, but now we're going to need it. Well, maybe what we need is the economy to turn around and start growing. Maybe what we need is inflation to come down and wage growth to stay elevated so we can get through this inventory problem and not have to worry about building more warehouses. These are on top of charges for warehousing, which are still at historic highs. Late fees and warehouse fees are passed on to the consumer, which is why we're not seeing products prices they're referring to fall as much as they should. I'll give you another view on that. Prices are going to come down when this inventory doesn't get moved and retailers and wholesalers get desperate. They're going to push this inventory out because they don't want it sitting in warehouses. They're going to nickel and dime those prices higher. It's going to eat into margins. And what it's going to be, again, they're going to be forced to lower their prices. So as we come full circle, they knew this was coming. They knew the CPI report was going to run hot. They knew this was going to set up the Fed, and the Biden administration, well, they too knew that the crude oil release was coming, and they also knew the consumer picture here is getting worse. You've got all the evidence that you need to see to tell you the economy later this year is likely headed to recession. The question is, did they see that coming too? I'm your host, Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.